Welcome back. Still tuned into the market, and let's focus in on Yes Bank. Talk about the high provisions that weighed down on the Q4 PAT. It was a robust cash rally, and you had the drop in NII, which hurt the Q4 earnings. Prashant Kumar is the managing director and CEO at Yes Bank, and he joins in to talk a little bit more about the numbers as well as the outlook going forward. Thanks so much for taking time out. Now, just taking a look at your numbers, you stated that the asset quality and recognition has peaked. You've made higher provisions in FY22 so that the earnings won't be impacted from the previous books, the FY22 earnings. Give us more color on the kind of NPA ratio, what earnings you've delivered as well this quarter.
So, like if we see on the asset quality front, I think December we were at the peak, and in December the standard still NPAs were also disclosed after our Q3 results. And after the Supreme Court verdict, all these accounts have slipped to the NPA category. But I think what we also need to see is that we have made a recovery of 5,000 crores. And in addition to 5,000 crores of cash recovery, there has been an upgrade of almost 777 crores. As a result of this, and also in terms of SMA-1 and SMA-2 book, that has also come down. As a strategy, we have proactively made the provisions on our existing book, and our provision coverage on the NPAs are 79%, and the provision coverage on the investment is 92%. So we are continuously strengthening the balance sheet and ensuring that the future earnings should not be impacted because of the credit cost of the previous year.
Now, the second wave of COVID has definitely been far more severe, and therefore, Mr. Kumar, there's a lot of uncertainty. Do you think in light of this, we could see higher provisions? Can you share some guidance as well on your credit costs?
As of now, it's I think too early to make any comment, but what we are seeing on the ground, I think in April, up to 15th of April, there was absolutely no issue. Subsequently, if we see like there are restrictions in movement, but I think this would be little different from the lockdown, which we have seen during the last year. We are seeing like the productions are happening, and even if you take the GST number, I think all-time record of April of almost 1,41,000 crores. So I think in terms of manufacturing activities, that is happening. Some impact is definitely there because of the restriction in movement. And our understanding is that this time, maybe it is very severe, but in terms of the length of the time through which there would be impact, that would come down. So we are quite hopeful that this year the impact would not be that much. And in our own book, the sectors which have been impacted because of the COVID, that we have already acknowledged as a NPAs and have made the adequate provisions. Going forward, I don't see the kind of stress which we have seen last year would be witnessed during the current year.
Right. Mr. Kumar, your gross NP ratio is still fairly high, that at about 15%. However, it is also due to the fact that your loan book has also shrunk. Is there an internal target that you have to bring down the gross NPA and further improve your provision cover ratio?
So I think the first most important thing, and I would request that our results should be seen in the backdrop that this is the first full year results after the bank was put under the reconstruction. And after the reconstruction, there was a pandemic also. So even through this cycle, if you see as on December, including the standstill NPA, we were almost at a 20% GNPA number, has already come down 15.4. And our target would be that by the year end, our GNPA number would be less than 10%. Similarly, with the additional provisions, our net NPA number are below 6. And if you see the net book, it has come down 20% as compared to December. So I think our recoveries, which we are targeting minimum 5,000 crores of cash recovery, it would help us in bringing down both GNPA and the net NPA number. And similarly, if we see on the retail and SME, which is now 51% of our loan book, there the NPA percentage is one of the best in the industry. Our gross NPAs are less than 3% and net NPAs are less than 1%. And in terms of loan growth, on the retail side, we have seen a 23% growth. So why our overall loan book appears to be contracted? Because of the additional provisions which we have made, which brings down the net NPA position, and also in terms of our strategy of debulking and de-risking the corporate book. But I think that process has now been completed. And next year, we will be seeing a decent growth. And keeping in view the guidance on the GDP growth, we are targeting a loan growth of overall 15%, where the retail and SME would contribute around 20%, and the corporates would contribute around 10%.
Well, Mr. Kumar, you preempted my question on loan growth. If I'm looking at Yes Bank from a 2-year perspective, how is it that your loan book mix will actually look like between retail, SME, your corporate book, etc.? If you could give us some color on the same.
So our retail and SME has already improved to 51% from 44% last year. And our target is to reach around 60% by in next 2 years. And if we see in terms of retail book, retail alone has already reached to 30% from 24%. And we would like to double the retail book over a period of 3 years. We are almost touching 50,000 crores in retail. It's a very good book if you see in terms of GNPA number and net NPA number, and similarly on the SME side. So we would take it to 60%, and that would also help us in improving the credit quality of the whole book.
Okay. You seem to be pretty stable when it comes to capital, your capital adequacy ratio at 17.5%. Given the loan growth of about almost 15% on a year-on-year basis, and given the uncertainty on the pandemic now, would you need to raise capital in FY22 or perhaps even early FY23?
So if you see in terms of provision coverage, we feel 79% on the loan side and 92% on the investment is quite comfortable provision coverage, and there is no need for us to make any additional provision on our existing book. But definitely, because of the uncertainties due to COVID, if there would be any further slippage, we believe that credit cost of that slippage would be taken care by our recoveries. And we need to remember that we also have a unique advantage of having a stress asset book of around 45,000 crores, where making recoveries would be comparatively easy. And I think that would help us in taking care of the credit cost. As of now, we don't feel any need for capital. Even 15% growth on the loan side can be supported by our existing capital. But if we find any opportunities going forward for the better growth on the loan side, we would not like to miss that opportunity due to the lack of capital. So I think as of now, we are good. But we have all approvals in place, and at any point of time, if any capital is required for a growth purpose, we would definitely evaluate that.
Mr. Kumar, your margins as well have been under pressure, and that's largely on account of the interest reversals. Can you give us an outlook as to where we see your margins headed?
So we already have a 2.8% margins for the full year. We would be moving towards 3%. So we are confident that next year our margins would be 3%, around 3% and plus. We are continuously reducing our cost of deposit. So in last 1 year, our cost of deposit has come down by 50 basis points. And with the, hopefully, the slippage, they are under control. So that way also would help us in increasing our margins.
All right, and give us a sense as to, what the outlook is, because for investors who are fairly concerned, the stock has taken a hammering. The bank has seen a lot of turbulence in recent times. What is the message out to the shareholders over the next 2 years? When can we see improved profits? When can we see improved return ratios? Is there going to be any further management rejig? I'm sure investors are fairly curious.
So I think if you recall, even last year, we have given a guidance of 1% ROA by FY23. We are absolutely on track of that. And the milestone which we have set up for the current financial years, we have achieved that. I would be saying, especially if you see on the deposit side, a 55% growth on deposits. Also having a good growth on the CASA deposits. Similarly, the growth on the retail and SME loans also. And comfortable capital position plus lot of recoveries. And I think we have made a good progress on the recovery side. So I think we are absolutely on track for our guidance of 1% ROA by the end of year of FY23. I think if we are able to achieve that, that should be a good comfort to our investors. And all those achievements have been made in the very first year after the bank was put under reconstruction and also during the pandemic time.
And finally, will there be any possibility of an M&A for Yes Bank? Or let me rephrase, would the bank be okay with or, comfortable with being acquired completely or being merged perhaps with another bank?
No. We absolutely don't feel that kind of situation. In the last 1 year, we have bounced back as a strong private sector bank. I think we would continue this journey. But if there is any opportunity for us to acquire any other entity, we would definitely evaluate.
Thank you so much, Mr. Kumar, for sharing with us your outlook. So they plan to double their retail book. As of now, not looking at any merger or any sort of an acquisition. They're saying that they have made proactive provisionings on their existing books and cash recoveries to the tune of 5,000 crores and 777 crore upgrades. They will be evaluating, of course, their capital needs going forward. Yes Bank, though, the stock continuing to languish in trade this morning, down about 5% at 13.8.